Hello students, welcome to Accounting Explained at Account-Wise Academy. This is Latha Venkateshwaran. In today's video, we are going to see straight line method of depreciation. Straight line method. The another name for this is constant charge method. Under this method, depreciation that is charged every year will be the constant amount throughout the life of the asset. If you are going to charge rupees 10,000 as the depreciation for the first year, then the same amount will be charged till the life of the asset. Accordingly, depreciation is calculated by deducting the scrap value from the original cost of an asset, and the balance is divided by the number of years estimated as the life of the asset. Suppose you have bought the asset for 1,10,000 rupees and the scrap value is nothing but the value you will get at the end of the life of the asset when you sell it. Suppose you are going to get 10,000 as a scrap value, then for the cost of the asset we have to take only 1 lakh for calculating depreciation. Suppose the life of the asset is 10 years, then divided by 10, it will be rupees 10,000 every year till the life of the asset, that is 10 years. The formula used for calculating depreciation under straight line method is depreciation is equal to original cost of asset minus scrap value divided by estimated life of asset. So in short form we can say depreciation is equal to C minus S divided by N, where C is the original cost of the asset, S is salvage or scrap value, and N is estimated useful life. I have taken a simple question on straight line method of depreciation. The question is as follows. From the following information, you are required to calculate the depreciation amount. Cost of the machine is rupees 30,000. Erection charges is rupees 3,000. This erection charges should be added to the original cost of the machine to calculate the depreciation amount. Estimated useful life is 10 years. Estimated scrap value is rupees 3,000, and this 3,000 should be deducted from the sum of these two amounts. Okay, when we solve the problem, we'll be able to understand it. So this is the question and the solution we are going to do. Calculation of depreciation for every year. Depreciation is equal to original cost of the asset plus erection charges minus the scrap value divided by the estimated life of an asset. Okay, so depreciation is equal to what is the this thing, cost of the machine is rupees 30,000 and erection charges is how much? Erection charges is 3,000 rupees. 3 plus 3,000, and what is the estimated scrap value? 3,000 minus 3,000, and estimated useful life is 10 years divided by 10. So 30,000 plus 3,000 minus 3,000 is 30,000 divided by 10 is 3,000. Thus the amount of depreciation would be 3,000 for every year under straight line method of depreciation. Merits of straight line method of depreciation. It is simple and easy to calculate. Original cost of asset reduced up to scrap value at the end of the estimated life. Okay, in the last example, what did we see? The scrap value of the asset was 3,000, right? So the value of the asset will be reduced till 3,000. That is, at the end of the 10th year, the value of the asset will be only 3,000. This is what this point says. Estimated useful life of the asset can be estimated under this method. Opposite way also we can find out. We can also find out the estimated useful life of the asset when the depreciation and cost of the assets are given. Demerits of the straight line methods of depreciation. I will explain each point with an example. It does not consider the intensity of use of assets. Suppose a delivery company purchases a truck for rupees 50 lakhs and the useful life of the truck is 5 years. Salvage value of the truck is 1 lakh. Then depreciation that will be charged every year will be 49 lakhs divided by 5 years is 98,000. However, the truck might be used intensively during the first 2 years and less frequently in the subsequent years due to reduced delivery demands. The straight line method fails to reflect this varying usage pattern. It ignores any additions or opportunity cost while calculating the depreciation. What is opportunity cost? Opportunity cost can be defined as the potential benefit lost by choosing one alternative over the other. The straight line method does not consider this. Suppose a company invests rupees 1 lakh for buying a machine. Instead, this it has used for buying the machine. Another alternative is it could have used it for a fixed deposit which will earn 8% interest per annum. Okay, straight line method does not consider the potential earning, that is the opportunity cost that is lost by purchasing the machine. It ignores the effective utilization of fixed asset. It becomes difficult to calculate correct depreciation rate. So the same example as the first one you can take. Same point only. Similar to the first point. Under the assumption of constant charges of maintenance of assets, it is impossible to calculate the true depreciation. Suppose a manufacturing company purchases a new machine for rupees 20 lakhs. The scrap value is 2 lakhs. So the amount to be taken for depreciation is 18 lakhs and the estimated life is 10 years. So the depreciation to be charged every year will be 1,80,000. However, technological advancements might render the machine obsolete after 7 years or unexpected breakdowns could reduce its useful value life too, right? The straight line method cannot adapt to these changes. It's very difficult for straight line method to adapt to changes because it considers only 1,80,000 constantly every year till the end of the life of the asset, that is 10 years, leading to incorrect depreciation charges. Question 2. A company charges depreciation on plant and machinery under constant charge method. Another name for straight line method is constant charge method at the rate of 25% per annum. On 1st January 2020, machinery was purchased for rupees 1 lakh and is estimated to have a life of 4 years. From the above information, you are required to prepare a machinery account. First, we have to open a machinery account. Okay, machinery account. And there has to be 4 columns: date, particulars, amount, date, particulars, amount. On the left side it is debit, on the right side it is credit. On 1st January 2020, machinery was purchased for 1 lakh and is estimated to have a life of 4 years. There are no erection charges that has to be added or scrap value that has to be deducted. So we directly take 1 lakh divided by the estimated life of the asset is 4, 25,000 to be charged as depreciation every year, since it is constant charge method or straight line method. When you buy a machinery was purchased for 1 lakh. See, when you buy a machinery, your machinery value, that is the asset value, increases. So machinery has to be debited by 1 lakh. Again, when you buy the machinery, your bank value decreases. Asset value decreases means it has to be credited to assets to bank 1 lakh. So in the machinery account it will be to bank. On 1st January 2020 it will be to bank account 1 lakh. Depreciation is to be charged every year, that is at the end of the year when the books are going to be closed. Here end of the year is 31st December 2020. By depreciation amount is 25,000, that is constant for all the years. On seeing debit side is more, so you take the total on both the sides. By balance carried on the same date, 75,000. This balance next year it will be brought down on 1st January 2021. It will be to balance brought down 75,000. Again end of the year 31st December 2021, by depreciation 25,000. 31st December 2021, by balance carried on 50,000. Debit side is total is more. So you write debit side total on both the sides. On 1st January 2022, it is true balance brought down 50,000. On 31st December 2022, end of the year, by depreciation, same amount 25,000. Debit side is more, take the total on both the sides. Again, by balance carried on 31st December 2022 is 25,000. On 1st January 2023, you are bringing the balance down. So, to balance brought down 25,000. On 31st December 2023, it is by depreciation 25,000. Now, the asset value has become 0. Total is 25,000 on both the sides. There is nothing to carry down. Balance, there is no balance carried down. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.